In 23 trading days of early 2020, the S&P 500 fell 34%, yet within months, new highs were in sight. Fortunes shifted by billions before lunch, but the calmest players grew stronger. That is the anti-fragile mindset, not resisting shocks, but harvesting them. Today, we engineer it into your money, step by step. Fragile wealth hates stress and snaps under pressure. Robust wealth survives stress and waits it out. Anti-fragile wealth feeds on stress, using volatility as raw material to build assets, upgrade skills, and buy cash flow at a discount. This is not optimism, it is design, with rules that convert chaos into returns. Start with a barbell. Park roughly 80% in ultra-safe instruments, Treasury bills above 5%, FDIC-insured cash up to $250,000 per depositor, per bank. Push the remaining 20% into high-upside, limited downside bets. The middle, over-optimized, overconfident, gets crushed when the unexpected lands. Data matters. The S&P 500's long-term nominal return sits near 10% annually, but year-to-year swings can exceed 20% in either direction. Inflation hit 9.1% in June 2022, erasing weak returns overnight. Anti-fragile investors price reality, returns, drawdowns, taxes, before committing a single dollar. Rule 1, never force to sell. Maintain 6 to 12 months of living expenses in liquid reserves. When markets drop 30%, buyers with cash write the rules, terms, timing, and price. Liquidity is not idle, it is permission to act decisively while others negotiate with panic and margin calls. Automate resilience. Dollar cost average on a fixed schedule, weekly or monthly, through all weather. This simple discipline, backed by decades of data, captures more shares when prices fall and fewer when they rise. It removes the most expensive variable in finance, your mood at 9:30 a.m. on a red morning. Set guardrails. Rebalance when an asset class drifts by 5% bands from its target. In a downturn, that rule quietly buys low, in a surge, it trims risk without drama. You are not predicting peaks or bottoms, you are enforcing math with unemotional thresholds, the bedrock of anti-fragile execution. Protect the downside with precision. A 2% allocation to deep out-of-the-money put options can cap catastrophic losses while preserving upside. Insurance always looks unnecessary until it pays. Anti-fragility is engineered margin of safety, a small, known cost replacing the risk of a ruinous, unknown bill. Build income that does not clock in. Target 3 or more independent cash flows, dividends, interest, royalties, or a lean digital product. If one stumbles by 50%, the others keep the lights on. Redundancy is not waste, it is a profit stabilizer that compounds during storms and acquisitions. Cap concentration risk. No single position above 10% of liquid net worth, no single decision risking more than 2%. Survivability scales returns, because compounding only works on money that remains. The goal is not maximum speed, it is maximum duration, like a car that wins at 200,000 miles. Exploit tax shelters that widen margins. In 2024, 401k employee contributions cap at $23,000, with a $7,500 catch-up at age 50 plus. Roth IRA limits are $7,000, with a $1,000 catch-up. HSA limits reach $4,150 for individuals and $8,300 for families, triple tax advantage. Cash yields are back. High-yield savings and short T-bills paid near or above 5% recently, risk-light returns funding dry powder. Do not chase an extra 0.5% with opaque fine print. Anti-fragile cash is simple, insured, and instantly accessible, the exact qualities that turn drawdowns into buying sprees. Inflation is a tax with perfect collection. When prices jump 8 to 10%, a nominal 6% return becomes a real loss. Hedge it in layers, equities with pricing power, rental income with annual escalators, and, when available, inflation-linked bonds. The win is not loud, it is persistent purchasing power. Borrow, but on your terms. Keep total debt to assets under 30% in volatile seasons. Fix rates when the forward curve signals turbulence, and stagger maturities like laddered rungs. Leverage is not evil, it is a racing engine. Anti-fragile drivers keep a roll cage, a fire extinguisher, and spare tires. Convert volatility into cash flow. Sell covered calls on positions you plan to hold, and cash-secured puts at prices you are thrilled to own. Collected premium lowers cost basis, tiny edges compounding monthly. Small, repeatable wins, with defined risk, transform chaos from menace into payroll. Price in tail events. Every few years brings a minus 20% shock, once a generation, a minus 50% crater. If your plan assumes smooth seas, it is not a plan, it is a wish. Run a premortem, identify 3 ways your portfolio dies, then design 3 antidotes you can execute in minutes. Barbells apply to careers. Anchor half your time in a durable skill, accounting, coding, sales, then invest the remainder in asymmetric experiments. One new client, course, or licensing deal can add 5 figures while risk stays capped. Optionality turns you from employee to enterprise, even while you keep the day job. Use decision circuits. For any 5-figure move, impose a 24-hour cooling period and require a 1-page investment memo, thesis, risks, exit triggers. This friction lowers regret and raises repeatability. When markets scream, your process whispers, here are the rules, here is the data, here is the size. Measure burn and runway. Households are small businesses, calculate monthly fixed costs to the dollar, then maintain 12 months of runway in safe assets. When job markets cool or sales dip 30%, you do not pivot under duress. You choose your opportunity set, at your price, with your tempo. Insurance is anti-fragile finance in disguise. Raise deductibles to cut waste, but never skip catastrophic coverage, health, disability, liability, and term life around 10 to 12 times income. A single uncovered hit can erase a decade of compounding. Real courage is knowing you can take the punch and stand. Avoid brittle expenses. Keep housing under 28% of gross income, auto payments modest, and subscriptions audited quarterly. When fixed costs are light, you can stomach drawdowns, and buy them. Flexibility compounds like interest, every dollar not chained to a bill is a dollar ready to seize mispricing. Score every opportunity with a simple grid, downside floor, upside ceiling, time to pay off, liquidity on exit. If you cannot cap the downside in writing, pass. If you cannot exit within 5 business days without drama, discount the upside. Anti-fragile portfolios prefer clear doors, not welded windows. Exploit micro edges. A 1% fee cut over 20 years can add 6 figures on mid-6-figure balances, pure arithmetic. Direct indexing can harvest tax losses while keeping market exposure. Anti-fragility is often quiet optimization rather than heroics, the sizzle is boring, the stake is real money. Systems beat swings. Auto-escalate savings by 1 to 2% every raise, automate bill pay, and schedule quarterly reviews. Remove willpower from the cockpit, install checklists, and let habits do the heavy lifts. When others sprint and stall, your conveyor belt hums, small boxes of progress, month after month. When fear spikes, widen your spread. In 2020, many quality businesses traded at 8 to 10 times cash flow, temporary discounts on durable cash engines. Set alerts for valuation triggers and act with pre-approved sizes. Panic offers coupons, prepared buyers redeem them while headlines shout catastrophe. Mind liquidity traps. Private deals offering 12% with no audited statements are not yield, they are stories. If you cannot value it weekly or exit in days, size it tiny or skip it entirely. Anti-fragile portfolios do not hide risk, they price it, cap it, and demand payment for babysitting it. Use the 3-2-1 data rule for your life's work. Keep 3 copies of critical files, on 2 different media, with one off-site or in the cloud. A cyber hit can cost 6 figures in a week: lost invoices, delayed receivables, legal cleanup. Anti-fragile money requires anti-fragile information. Set quarterly scenario drills. What if revenue drops 25% for 3 quarters? What if rates jump 2%? What if a client paying 40% churns? Pre-wire moves, trim costs, pause hiring, rotate from growth to value, and store the playbook where you can run it at 3 a.m. without debate. Practice half-Kelly sizing on asymmetric bets. If math suggests a 20% allocation, consider 10%, staying solvent when variance slaps. You will be wrong often, but never fatally. Anti-fragile wealth compounds not by being right every time, but by surviving comfortably every time it is wrong. Guard your bandwidth. Sleep 7 to 8 hours, train your body, schedule deep work in 90-minute blocks. Cognitive drawdowns cost more than market drawdowns: missed details, sloppy sizing, delayed exits. You are the primary asset. Protect operating temperature between 68 and 72 degrees Fahrenheit, calm, alert, decisive. Embrace tiny experiments. Allocate 1% of income monthly to skills and trials, courses, micro-ads, prototypes. Most will fail cheaply, a few will pay 10 to 50 times. Optionality is a lottery where you print the tickets, set the odds, and refuse to risk the rent. Write exits before entries. For every investment, record 3 triggers: price-based, time-based, and thesis-based. If valuation stretches 30% beyond fair value, trim. If the thesis breaks, moat erodes, margins compress, exit. Anti-fragile investors do not marry positions, they date them with prenups. Rehearse the calm. When the VIX spikes and cable shouts crisis, you read a single page: reserves intact, hedges active, buy limit staged, rebalancing due. Then you take a walk, breathe for 2 minutes, and place orders already sized. Precision beats adrenaline, every single red day. Teach your household the dashboard. Net worth snapshot, monthly burn, cash runway, debt maturities, and top 5 risks, updated on the first Saturday, reviewed in 20 minutes. Shared clarity prevents expensive arguments at 2 a.m. Anti-fragility thrives when everyone rows in rhythm, not when heroes sprint alone. Document your scars. Keep a 1-page postmortem for every loss over $1,000, what you saw, what you missed, and the fix. Repeat offenders get blacklisted for a year. Improvement is not inspiration, it is paperwork. Anti-fragile investors upgrade the operator, not just the machine. Here is your compact plan. Build a 12-month cash runway, automate contributions, enforce 5% rebalance bands, cap position size at 10%, and ensure the catastrophes. Add a 2% tail hedge, 3 income streams, and quarterly scenario drills. Simple, repeatable, and brutally effective under pressure. You now carry a shock absorber and a turbocharger. When the next -20% headline arrives, you will not freeze, you will execute. Tell me the one anti-fragile move you will implement this week, then subscribe for deeper drills, like and share to help more people build unbreakable money.